Hi, I'm Rory Johnston, Commodity Economist at Scotiabank. The global economy remains remarkably strong, and demand for raw commodities is benefiting from robust industrial and consumer activity. Our consumption of fuels, metals, and materials is accelerating just as the supply outlook is beginning to weaken. A half-decade of surplus supply is yielding to tighter markets, and prices are finally beginning to move higher across the board. Years of lower prices have reduced the incentive to invest in new mines and wells, but now rising commodity prices are signaling the need for more upstream investment and shining a spotlight on bottlenecks in supporting infrastructure like rail and pipeline capacity. And even if we're not destined for a repeat of last decade's China-driven supercycle, we're almost certainly embarking on the upward slope of the next commodity price cycle.
Hi, I'm Michael Loewen, Commodities Strategist at Scotiabank. As Rory has touched on earlier, energy prices, primarily crude oil, need to climb higher in order to incentivize renewed development. Capital spending has been primarily concentrated in North America and Brazil over the last number of years. Yet on the other side of this equation, demand growth is expected to be very strong due to sustained economic advancement in Asia and more generally in emerging markets through the end of the next decade. Over the last couple of years, energy markets have experienced a tremendous recovery. Domestic E&Ps are leaner and have healthier balance sheets. Drilling and completion costs have been driven lower, and pipelines are experiencing a surge in throughput volumes. This has created a stable and flourishing energy sector. Though the liquids market appears fundamentally strong, the power and natural gas market offers a much more tepid outlook. The decline in cost of renewables power generation has elongated the supply curve and developed into a more stable and lower power pricing environment. Fracking technology is certainly having an impact, but natural gas supply growth is increasingly being driven by an adjacent liquids industry through associated gas production. The good news may be that lower natural gas prices typically spur structural demand growth. At the same time, the US is building significant export LNG capacity. And there are plans in the works for Canadian LNG solution as well. This could provide a solid foundation for a recovery into the next decade.
Hi, I'm Shaun Osborne, Chief Currency Strategist at Scotiabank. Rory and Michael have highlighted our expectations for commodity prices, and from the currency perspective, rising commodity prices usually support demand for the currencies of commodity-producing economies, like Canada, by delivering stronger growth and improved trade balances. The positive outlook for commodity prices helps support our constructive outlook for the Canadian dollar over the course of this year and into 2019. Conversely, higher commodity prices usually have negative economic consequences for the economies of larger commodity consumers. Countries like Japan, for example, which has to import virtually every raw material used in the domestic economy. In this case, rising commodity prices have an adverse impact on trade, as higher prices drive imports up and domestic prices higher. This tends to have a negative impact on the currencies of these economies. One way investors can leverage either rising or falling energy prices is to play the Canadian dollar-Japanese yen cross. The Canadian dollar has one of the strongest positive correlations with the price of crude, whereas the Japanese yen has one of the more persistent negative correlations with crude amongst the major currencies. All else being equal, the Canadian dollar will appreciate against the Japanese yen when oil prices are rising, and it will tend to underperform against the yen when crude oil prices are falling. You can find more in-depth economic and global currency analysis on our website, and you can also follow us on Twitter at ScotiabankGBM and at ScotiabankFX.